I'd like to welcome our second panel to the stage. They will be discussing uses without abuses of consumer data. We've touched on this a little bit earlier today with some of the credit scoring issues, and we're delighted to have them explore the issue further. Moderating our discussion is going to be Colin Wilhelm, who is a reporter for the Washington Examiner, where he covers economic policy, and we are delighted to have him with us here today. And it looks like just in time for the set change. Y'all can walk on. Thank you so much. Please join me in welcoming Colin.
We can go on.
Take our seat.
Oh, and the panel.
We were just going to leave you up there to do your own thing.
Yeah, I can do 40 minutes. Well, thank you so much to Cato for having us today. Thank you all for being here. I'm interested maybe in a little bit of interaction to begin with. Show of hands, who's familiar with alternative data uses in financial services? So we got a pretty informed crowd here, but still some hands down. So I want to start out with our panelists. Can you explain a little bit how alternative data is being used in financial services? We can kind of go down the list, and maybe some of how regulators might be thinking about that.
Yeah, so perhaps it can start. So Finicity is a technology company, primarily data access and analytics. So we've been focused in this area almost exclusively in terms of powering a number of the solutions, the new solutions that are coming to market. Specifically, of interest in alternative data is credit scoring. And there's been some discussion already today about that. And so a couple of new products that have been announced, and one that has been launched and the other that's in pilot right now is the Experian Boost product, which allows consumers to permission access to their financial institution account. Finicity provides the technology that allows them to both permission and access the information. Then we're looking for, payments to utilities and telcos and mobile phone payments. And if those payments or those streams of payments meet certain rules, then they can be applied directly to a person's primary credit report with Experian. And a new score can be rendered on top of the FICO 8 or 9 scoring methodology. The other product is that was announced at Money 2020 and is currently in pilot with 5 lenders is the Ultra FICO score. And in this scenario, Finicity, again, with permission from the consumer, can gain access to their financial institution account and look at the way that they interact with their financial institution account. So rather than looking for specific trade streams, we're looking at attributes associated with the way they manage that account. Do they maintain a positive balance, for example? And there are a number of other attributes that are calculated. Those attributes then fed directly into the FICO scoring engine, together with the existing credit file that's available, or if there is not a credit file available, a score can be rendered. So in both cases, either the Boost product or the Ultra FICO scoring product really impact the 53 million that are either credit invisible or have this significant opportunity impact the 53 million that are either credit invisible or thin file.
So in that case,
they're banked.
In that case, you're talking about using bills and payments that people are already making to try to enhance your knowledge about them, because they might not necessarily be seen by some of these credit bureaus because they don't have a credit card open or a bank account open, something like that.
Yeah, I mean, effectively today, the credit system that's been set up has been around for 30 years. Requires you to have credit to get credit.
Right.
I mean, you've got 10,000 lenders that report into the bureaus as furnishers, and you have to have a trade account, a loan, with a financial institution that's reporting to a bureau to be effectively scored, right? So when FICO set out to understand how additional information could be used, they really started to focus on, there are a lot of people, significant number of people that pay for services on a monthly basis that require them to be responsible payers to have those services, like utilities of all kinds, mobile phone, telcos, and to the extent those payments are being made regularly, then that data, if we can get access to that data, then we should be able to render a score, which is really, two pillars: a person's propensity to pay and ability to pay, to gain access to, higher quality credit. So.
Rob, can you talk a little bit about how banks might be thinking about alternative data? Are they able to use it to the extent that they might want to, or are there any sort of hurdles to that?
Yeah, thanks, Colin. And first, let me start by thanking Cato for hosting this discussion on a really important issue. I know personally, this is why I do what I do. I think there's a lot of opportunity, and our banks think there's a lot of opportunity for data to help drive financial inclusion and bring more people into the banking system. When you start looking at this alternative data, it can be really powerful, and it can be used to include a lot of people. But if used the wrong way, it can also be used to exclude people. So we want to be really careful about how we're using data, and that's what we see in the banking industry today. Our banks are looking really carefully at ways to leverage the power of this data to bring people in, but we do that within a really heavily regulated industry with oversight and a strict set of rules assigned to that data to make sure that biases don't creep in and to make sure that we're using that data responsibly. So excited for the discussion. I think there are a lot of ways that banks are leveraging this data to drive that sort of inclusion. But I think it's also important to highlight the controls that are in place to make sure it's not used inappropriately.
And how are the Fed, Dan, formerly of the CFPB, but how are the regulators thinking about this? How do they want to see this applied? What are some of the concerns that are maybe out there?
Yeah, no, thanks for the question. I think I'll start a little bit by taking a step back and talking a little bit about what we're seeing by so-called alternative data in terms of at this point. So we see a lot of institutions using a wide range of data in fraud detection. So, a lot of these online channels they create greater opportunities for fraud, but there's better access to information to help combat fraud. So we see a lot of uses of non-financial and other data to help combat fraud. When we talk about alternative data on the lending side, at this point, we're not seeing a lot of non-financial data. So when we talk about non-traditional data, it's been more new ways to get access to information that speaks to cash flows, income, and expenses, and more sophisticated algorithms to analyze that data and determine whether or not you want to provide credit to somebody. So I just wanted to be clear there that we're not seeing, when we say alternative data, I know that sometimes you think of non-financial data. We're not seeing a lot of that at this point. It is mostly different ways of looking at financial data. And to leverage on what Rob said, yes, there is great potential here for increasing financial inclusion, and you have to balance that against the potential that the data could be used inappropriately, that the data might not be as predictive as one had perhaps thought going in. And so you have to be careful that you don't have the unintended consequences, because you have the opportunity for both good things and bad things to happen at scale. So that's how we're thinking about that now, which is really trying to bring the balance into the discussion, but recognizing that we've got to be really careful with these new data elements and these new algorithms to make sure that we're getting the intended outcomes.
And that's interesting that you say it's being used right now more for fraud prevention or detection rather than underwriting, because I feel like that's where a lot of the conversation is, but maybe there's still kind of a feeling out process as to how this can be used for underwriting and what some of the most effective data points might be, but also making sure that you're not violating something like a fair lending law.
Exactly. I think that institutions are a little more cautious on the lending side for good reason. But we do still look on the fraud side. We do want to make sure that if the data you're using to trip fraud flags, if it's resulting in somebody being denied a service or being steered to a different service, that you are also looking at the predictability of that data, and that you're not inadvertently steering people to more expensive products or to other less desirable products because of an inappropriate fraud flag.
And Dan, you've looked a lot at use of consumer data. In your experience, what are some of those effective variables, and how do you think that regulators might be able to allow companies to experiment a little bit more with the use of this in a way that's sort of controlled and has outcomes that regulators might want to see?
Sure, thank you, Colin, for the great question. So I think I'm wearing kind of 3 hats now. One is the former hat as the head of CFPB's Innovation Office, the current head of Adjunct Scholar at Cato. This is my first Cato event. Really thank Lydia and Diego and George for setting this great event. And the third hat is sort of I'm also an advisor to a lot of fintech companies, both at the early stage and the growth stage firms. And many of the companies are using what we call alternative data, not just sort of in underwriting, right? Just thinking about the concept of PFM, right? Personal financial management. It's been around for more than 10 years, right? But I think more increasingly, as the data becomes more available, as the quality of data improves, some of the non-bank companies are able to leverage that data to really predict someone's, upcoming bills and help people more effectively. More, in the past, PFM more of sort of is passive, right? Here's the financial picture. You manage yourself. Now companies are getting more sort of active, helping consumers more actively, proactive even manage their financial lives better. Now, what we talk about alternative data here on this panel probably is more relevant to how the new data source can be used in credit underwriting, right? I think the goal here is obviously about financial inclusion, right? So when I was at the CFPB, when we look at this case with Upstart, Tom, you worked with me on that case for probably too long. I don't know if that's good or bad. I think at the current stage, a lot of the fintech companies, even banks, are thinking about how we can leverage this new data, which is mostly, as Tracy mentioned, cash flow data. And in some cases, in Upstart's case, they use educational variables as well in their underwriting. It is really sort of how can we use the new source of data to incrementally improve financial inclusion. So folks, I believe most folks in this room, other than some of the Cato interns, because they don't have a credit file yet, but we probably can comfortably get any credit at a very low cost at any financial institution. But if you're young, if you're a new immigrant, if you are, what we call traditionally underserved, it is very difficult to get affordable credit at any institution. Now, with this new source of data, and with also machine learning and AI, we can possibly increase the likelihood of this new population, of this underserved population to get credit. So that's what I think where the experimentation has been mostly, and it's sort of a kind of like second look, if you will, right? But ideally, if we believe this technology is mature enough and the data is good enough for lenders to really feel comfortable using them, there shouldn't be any second look. There should be just one look, right? So on the within the banking system, I think there's a lot of reluctance from bankers to use this new source of data or experiment with machine learning. But I think the desire is very strong. I'm also advising a lot of the companies at McKinsey. So McKinsey has done a study. So they show the number one actually obstacle for banks to adopt machine learning or look at the non-traditional data is actually talent and the IT system, right? They don't have the kind of capabilities. That's where fintechs can help. A lot of fintechs are actually trying to white label their service to banks. Upstart is one of such examples. So I think it's going to take a while for regulators to really be on the same page. And I think the innovation is happening in Silicon Valley, in New York, in everywhere in the country. Is really at a breakneck pace. I think it's really important for policymakers, for regulators to really get ahead of the curve and understand the implications and to work with the banks. I think at the end of the day, banks have the biggest reach to the customers. So fintechs can do so much sort of on the edge, on the fringe. At the end of the day, they want to work with the banks. And that's where we see the biggest impact is going to come.
Go ahead, Rob.
No, I was just going to say we see a lot of the same thing. Our banks are really eager to work with a lot of the startups in this space, and we see the development inside and outside the banking space is really supporting that same goal. We all share that goal, right? Extending credit to as many creditworthy borrowers as possible. But as we think about sort of the alternative data space, the rules really, particularly as we think about AI and some of these new technologies, the rules are different depending on the use case, and they should be, right? If you're trying to find fraud and you have an AI algorithm that really reliably finds fraudulent transactions, you might not need to know exactly why it's flagging those transactions. But if I'm making a loan, I need to explain why I'm turning a borrower down. And you need that level of explainability to figure out why is this algorithm making the decision. And if we think about what AI is at its core, is it's moving from a world where we have a hypothesis, we test it, and establish causation, to throwing a bunch of variables into the washing machine and figuring out what things that we may or may not have realized are correlated to each other. And so that machine may go in and say this one factor is really highly correlated to creditworthiness. Well, it may also be highly correlated to something else that you can't make credit decisions on. And so I think from a banking perspective, banks need to show not only that this data is predictive, but that it's not relying on protected classes and making loan decisions based off of criteria that banks aren't allowed to. So from our perspective, our banks are really interested in trying to leverage some of this data, but one of the hurdles is lack of clarity around how to actually prove that the models developed through some of these machine learning processes don't have a disparate impact, and to what level they need to prove that the data is predictive.
I would add to that from a regulatory standpoint. Certainly there's the ensuring that the data is predictive and it's not otherwise discriminatory in any way. But you also have the transparency aspect of it. You mentioned having to, if you decline a loan, having to tell the borrower, the applicant, why they didn't get the credit. So there has to be some transparency into which factors in this algorithm resulted in the denial, so you can tell that to the borrower. I think there's also this idea that borrowers should have some understanding of which data is being used, and perhaps even an ability to make sure that that data is accurate. In today's system, most people understand which factors influence their credit standing one way or the other, and know that if they engage in certain behaviors, they'll become either more or less creditworthy. And how do we preserve that so that borrowers understand what behaviors they need to engage in order to be able to obtain credit?
Sure, and I mean, there's still frustration too with the existing system, even though there is some clarity on that, because a lot of times you'll get bad data in there. And this also seems to dovetail into some privacy issues too. Like, how do you control what your bank knows about you? Is there a way that regulators can kind of think about this, or your lender thinks about you, and what's acceptable, where some of these guardrails are? What do you think going forward can be done to kind of like provide a path for that, to where you say, hey, there's some innovation here, but let's balance it with not overstepping in terms of what we're collecting on people. Obviously, there's a lot of privacy concerns going on right now.
I think I can talk to that just a little bit. The fintech world is moving very, very quickly, but our philosophy is essentially it needs to move in lockstep together with the mainstream of the financial services industry, and that means that we need to partner. We need to understand both the concerns on the regulatory side as well as the concerns for maybe disparate impact on data. All of that said, I think our view is that you can't jump immediately to pulling transaction data and doing 100% underwriting on cash flow. It's likely not going to work. The way that we get there is we use models that everybody accepts today, right, as a standard, and we augment those models in a way that we can rely on the predictive nature of those models, enhanced by additional data, and so we actually can test with additional data with certainty what the risk analytics look like, and to the extent that we can go about it in that fashion, then we're going to be able to move forward to a place where, who knows, maybe one day we'll get to a 100% cash flow underwriting model, and we can do it quickly and easily, and the algorithms are well understood, the risk metrics work, FCRA compliance catches up with new data types, and consumers are fully protected in their ability, as they are today under FCRA, to have access to any report that's created on their behalf, and if there's a credit denial, they have the ability to review and dispute, right? So creating the CRA framework around new data and data types and what a furnisher looks like in a new world is those are challenges that we need to think about and work through. But there's no reason why today we can't start making significant progress in bringing more people into access to higher quality credit, lower cost credit, based upon the access to information. The data is really indisputable. It is very predictive, and the existing models that are out there today speak to that. Since 2010, there's been a significant amount of work done in this area to understand how transaction data can be used to understand and predict clearly ability to pay and propensity to pay, and so there's no reason why we can't start making that progress today. And I think that the two examples of that, both the Experian Boost product, which really just adds trade lines to your existing credit or creates a credit profile for you with trade lines and utilizes the same scoring methodology that's already been tested through FICO 8 and 9 and is widely used in the financial services industry. That's a great example of leveraging today's risk analytics and improving inclusion by creating access to more information, right? And Ultra FICO, same thing, right? They're using FICO 8 and 9 algorithms to improve with the addition of data, more data to include more people, but rely on the predictive nature of those analytics from the past. So I think to the extent we can leverage that, we can move forward. To the extent we can move forward, we can start looking at additional uses for that data.
Yeah, and let me just add on the privacy point. I think it's a really good question. And when you start talking about data and leveraging more data and using more of a customer's digital footprint in making these decisions, it's important to note that financial data is already held to a higher standard. There are rules in place. Gramm-Leach-Bliley protects financial data at the data level. So nationally, as we're having a conversation about data and privacy and whether or not new rules are required, it's important to note that there already are these sort of rules in the banking space that require customers be notified about how their data is being used and where it's being moved to. So when you talk about privacy, really banking data is the gold standard today. And Steve, I think you did a really good job of highlighting sort of the second piece here is, as we're thinking about alternative data and lending, we're starting to see some of it today, but it is still mostly looking at financial data, not what brand of toaster I own. And so when we're thinking financial data, there is that clear connection to, because I have cash flows to pay off a debt, I have the ability to pay that. When we start talking about data that's further out there, there's not that same clear connection. So I think that really is where a lot more of the opportunity sits.
I think on the issue of privacy, I think one important thing we need to look at is really about the transparency. So in the case of consumer permission data access, the consumer permission is really the most important part, right? The consumer actually permissions you, the lender or whoever, to use my data, whether it's mostly financial data, for X purpose or Y purpose, right? Whether it's for boost my credit score or for me to apply for a mortgage digitally without having to download and print my bank statements for the past 3 months. So once the purpose is fulfilled, are there anything that you need to do with my data? So I think what's really important is when you offer this product to consumer using their transaction data, you have to really be very clear in the permission that the consumer is going to grant you. And we'll also talk about probably how long the permission is going to last, right? If it's a one-off thing, applying for mortgage, the permission should be just one time, right? If it's a PFM, longer term, monitoring your cash flow, that should be, months or weeks or years even. I think there should be ways for, we're not getting there yet. I think it's going to take some time. I think there are some organizations, the FDX, for example, Financial Data Exchange, they're trying to work on, things that are really trying to, put consumer in control, right? So at the end of the day, this is our data, right? You have the right to share with anyone you want to share, but at the end of the day, you want to make sure that the entities that actually you share data with are taking the responsibilities very seriously.
And what are some of the lessons that can be learned from other jurisdictions across the world have kind of been grappling with this issue too? You've got PSD2 in the EU. You've got sort of the open banking initiative in the UK. I think Singapore has also been doing some work with regards to data exchange and usage. What are some of the lessons that you think can be applied from those instances, good or bad, to how the US kind of grapples with creating policy around further use of alternative data or controlled sharing of data?
I mean, I'll start there. I think, you know, the discussion on privacy and some of what you raised highlights that it's a really complicated problem, and there's lots of different angles to come at this from, whether it's privacy, consumer preferences, business effectiveness, security, and that when you pull on any one of those levers, it has an impact on the other. And if you just look from a privacy standpoint, you know, there's a tension there, right, between consumers who want privacy, and yet they want the frictionless, quick decision to access, and those two don't always work in concert with each other.
Why can't I have everything and have it now?
Exactly.
Yeah.
And so I think that, you know, there's a lot of ways you need to think of this, and I think some of these other jurisdictions are seeing some of these tensions play out, and that to me is where the learning is, to where we can start having better conversations here about what kind of framework do we need to put together to think about all the different angles here and where you would want to land, what you give up if you have privacy here versus privacy there on the spectrum.
Yeah, and I think, no, go ahead.
Just give a quick example of what some of those tensions might be specifically, or how they're being seen specifically.
Yeah, so the privacy is one of them. There's security and liability tensions around that as data moves through various, you know, if you've got a fintech company, an aggregator, and a bank in the channel, there's tensions around the liability issues. Security certainly is a big issue. We have great examples of institutions who, you know, increased their fraud and AML controls because they felt that they were not as secure as they wanted to be, and what that created was it slowed down access to funds for some consumers who were low and moderate income, and that had an impact. We had another who lowered their fraud controls because they wanted to provide the quicker, faster service and didn't appreciate that the kind of ACH authorization they put in place exposed them to a huge fraud, and it was a fairly sizable fraud for a fairly small company. So those are, to me, would be some of the other tensions here as you're thinking about all the different angles to come at data from a policy standpoint.
Thanks. And Rob, I didn't mean to cut you off.
No, it was an important point. And I think one lesson as we look globally and see what's happened in the UK and the EU, and look at the approach that the US has taken that's a little bit different, is we've taken a market-driven approach. And I think we're starting to see the benefits of that. Industry is working together. Steve, I think you're part of FDX as well. The banks are part of that. And we're bringing industry together to drive a solution that's actually solving the problem that customers have. Our banks hear that it's a customer imperative. We want to be able to share our financial data with third-party apps. And because of that, we're working together to make that happen. Where when you look at jurisdictions like the UK, they have requirements for this, but those requirements only extend to certain accounts. So if I'm using my deposit account and my debit card for payments in the UK, or the equivalent, then that's included. But if I'm using my credit card, those transactions aren't. So what we're seeing is a more wholesome look at this in the US, and I think we're seeing a more collaborative approach. So, you know, from a banking industry perspective, our banks support customers' ability to move data wherever they see, but we take a principled approach that focuses on that customer. And I think you brought up some of the key components. For us, we think customers deserve first security, bank-level security wherever their financials data is stored. Second, transparency, clarity about where their data is moving, who's taking the data and how far downstream that goes, and then how that data is being used. And then finally, third is control, the ability to turn off the spigot when you're no longer using a service. Dan, I know you sort of hinted at that as well. And I think we're making really big strides in that with some of these technical standards like FDX.
Yeah, so if I can speak to that for a minute, you know, the objective, I think, in the U.S. is to clear the path for great innovation. So to the extent we hold back or we create friction, innovation is stymied or halted altogether, and I think that's some of the impact that we're seeing in some of the other jurisdictions. So this is clearly in the U.S. today, at least it is a market-driven approach. FDX is the first organization of its kind that represents the ecosystem. So it's fintechs, it's banks, it's aggregators, it's you know, those who who utilize the data, those who are stewards of the data. And it's interesting that many, fit on both sides of that aisle. They may be stewards of the information, but they also utilize the information in the case of many banks. 20 years ago, 4 companies got together to talk about how devices in short range could talk to each other. And they set out, they were all fierce competitors. They got together and they said, if we don't work together, we won't create an ecosystem that allows for open innovation. And today, we all have devices that have a little logo on them that refer to Bluetooth. Today, billions of devices connect without consumers even thinking about it. And that's because industry got together and created standards around interconnectivity, standards around secure data transfer between devices, standards around handshaking with devices, standards around how that Bluetooth, the Bluetooth wireless range works with other wireless frequencies like cellular frequencies and 802.11 with Wi-Fi. I mean, all of those things were solved by an industry group that now has 30,000 members, billions of devices worldwide connecting, and it's a perfect example of how industry can solve these problems if given an opportunity to do so. So, Financial Data Exchange now has 25 sustaining member organizations. We're addressing things like user permission, data traceability, the ability to turn on and turn off access at your primary financial institution. You allowed your data to be used to underwrite a mortgage, and that shows up in your dashboard. And if you want to turn it off and it's still there, you can turn it off. So the ability to permission which accounts you use for different types of things, not just all accounts. So you could choose to add a checking account to a PFM and a credit card to some other kind of a product. So it really creates the standards for security, for data traceability, for user permission, and puts the consumer in control. And I think that's really what's going to drive continued innovation in the space and allow this interoperability concept to flourish, so that we can really achieve the objectives, which is to utilize data in ways that absolutely benefit the consumer and bring them into the fold of the very best financial products and services.
Yeah, and it's funny, just listening to this seems like common sense, but it's important to recognize how far we've come, right? It used to require customers giving up their username and password, something that any security expert ever will tell you is a terrible idea, to their most sensitive thing, their bank account. And we've moved to a world where customers actually have control over that from this sort of privately and industry-driven approach.
So I want to give the audience a chance to ask some questions of this excellent panel. Can we line up? So we've got one there, and then another there at the top, and then we'll try to get these two up here.
Good morning, how are you? My name is Evelyn Williams, and I'm with the Securities and Exchange Commission. And this question is to Rob. You mentioned earlier that you wanted to prevent biases from creeping in. My question to you is, what measures does the ABA have in place to prevent bias, unconscious and conscious bias, as it relates to consumer data?
Yeah, so that's a great question. And as the ABA, we're not actually using this data ourselves to make those loans, but our banks are subject to all of the suite of regulatory of rules and regulations that are in place to make sure this is the case, from UDAP, where we can't undertake unfair, deceptive practices, to fair lending. Really, not only do banks need to show, give customers reasons for why lending decisions are made, but they need to prove that the data they're using is first predictive, and second, that there isn't, not only that it isn't based on any sort of bias factors, but that the factors that are used don't even correlate to those bias factors. So they have to go through a really extensive study in order to use any new data element that shows what's being used, why it's being used, why that's not bias, and a secondary step to make sure biases haven't crept in in the ultimate implementation of this.
And just a quick point of clarification, when you say they have to go through a study, who conducts that study? Is that something that gets contracted out to an academic or?
So the banks conduct that study in partnership with academics and make the case for every individual data element that comes included to their regulators who are in the offices every day sort of checking how each process works. You may have something
No,
to add
I
there.
think that's a fair point. I think that what I'd emphasize from there is, absent a program where you have a no action letter or some sort of U.S. regulatory sandbox, there is still the opportunity to always work with your regulator as you're thinking about entering into new products or new ways to utilize data, whether it is in fraud or underwriting or financial management, whatever the purpose is engage in that dialogue, because as a regulator, we want to work with you. If there's a way to make this happen and make it happen responsibly, that's our goal as well. And that dialogue helps us also be better prepared and better understand what you're doing when it comes time to evaluate how we think about that.
Well, I just want to mention one thing. So I think the biggest problem today is not really about how to prevent the biases creeping to the system. I think it's very important that we need to make sure biases don't creep into the system. But the biggest problem is we have, well, the number is different, right? Everybody has a different number. My number is 40 million Americans who just don't have access to credit. So it's a huge number. So how can we really leverage the new source of data and machine learning AI to really help, even marginally, some of these people get into traditional banking system or credit system so that they can have affordable credit options? So, and I think we are really at a very, very early stage. I think a lot of regulators, and I can speak for the CFPB. Well, I cannot speak for the CFPB. But being there, I know, how little understanding the CFPB had, I probably today still has, about this, alternative data sources and machine learning AI. And I think it is really important, to Tracy's point, it's really important for policymakers, regulators to engage proactively with the innovators that are experimenting with these new methods. And with the eye that, we have to make sure, biases don't come in, because that's very important. Fair lending is very important. It's, it's protected classes. But at the same time, we need to really be cognizant of the fact that there's so many Americans, and many of these Americans are the people that we're trying to protect who don't have access to credit.
Thank you very much. This has been a great panel. On the privacy question and the alternative data question, if as a result of, if there is privacy legislation or privacy changes, we move to a paradigm, let's say, where individuals basically own their own data and are able to move all of their data, social, financial, et cetera, around, potentially get compensated for that, almost creating a market for this data, how would that affect the financial market, and would financial institutions find such a world where they could, in theory, a user could, in theory, permission all of their data to them in exchange for something? Would that be helpful to them in terms of serving their customers?
Yeah, I can take a quick swing at that from a bank perspective. I don't think that changes the way banks treat this data today. Banks act as trusted custodians of customers' most sensitive data today. And just like they work very hard to keep funds safe, they do the same on the data side, and to make sure that you have access to that where and when you need it. The same way you have a debit or a credit card in your pocket that you can swipe and get access to those funds in a secure way, banks are working through organizations like FDX to give you that same sort of power to move your financial data. So I'd say that's really what we're working towards already.
All right, and then I think, so quickly maybe here, and then if we have time, if we got a, getting up close to the deadline. Yeah, right, yeah. Yeah, let's do 2 questions real quick and then see if the panelists can field.
Thank you for an excellent panel. My name is Marian Danis from the National Institutes of Health, and I wanted to ask you a little bit about the problem that we face, that many people who are having trouble with their finances are doing so because they've had health problems that bankrupt them. And I wonder whether you might talk about the fact that these people remain vulnerable because the data is about their finances are going to provide a picture that makes them risky financially. And if our goal is to help people, does this agenda provide some way for the very most vulnerable?
One thing that I would mention on that is one of the studies that was done in 2010, MIT took a look at how you could use transaction data together with standard credit data. And what they understood from that is that standard credit data moves very slowly. In other words, if you have a significant impact in your life, financial impact in your life, it takes a little while for that to show up in your credit score. Conversely, if your financial position improves quickly, it takes a while for that to show up in your credit score. And so getting closer to a cash flow underwrite certainly helps you understand the risk downward more quickly, as well as the improvement upward more quickly. So, acceleration is helpful. And at the end of the day, I think that the closer we can get to cash flow, I think the better decisioning we can do.
I think, unfortunately, that's all the time we have. But please join me in thanking this excellent panel, and thanks for your time.
Thank you. That was great. Yeah. Steve, thank you.